You've been told 100 times, the stock market is where companies get funded, where businesses grow, and where you can make a fortune by buying and selling pieces of those companies. You probably know that when the market goes up, the economy is doing well, and when it crashes, it's bad news for everyone. But what if I told you the stock market isn't actually about stocks at all? In fact, what you think you know about the market could be completely off. What's really happening in the stock market might be even stranger and more important than you've been led to believe. This isn't a conspiracy theory, it's a story that's been unfolding for decades. So let's rewind, because what you're about to hear might change the way you think about the money system forever. We're living through an era where the stock market doesn't just reflect the economy, it controls it. Think about it. Every time you hear the phrase economic health, the stock market's performance is probably right there, front and center. The media loves it. Politicians use it to brag about strong economies. And for most of us, the market feels like a snapshot of how things are going, a way to measure the pulse of the world's financial system. But what if that pulse is fake? What if the stock market isn't really about stocks at all? What if it's a whole different game, one that has nothing to do with the real economy? That's exactly what we're going to uncover today. Let's start by clarifying something. When you hear the stock market, you probably picture the iconic ticker tape scrolling across the screen. Companies like Apple, Tesla, or Amazon. They're the ones you're investing in, right? Well, sort of. In theory, yes. You buy shares in a company because you believe that company will grow, that it will deliver value, and that you'll see returns from that growth. You own a slice of it. You're part of the story. You're helping fuel its expansion, right? But here's the twist. Most of the time, the market isn't really concerned with the company's growth. It doesn't care about the quality of the product, the strength of the management, or the innovation behind it. Not directly, anyway. The market is primarily driven by something else, speculation. The buying and selling of shares isn't about supporting a company anymore. It's about betting on price movements, chasing trends, and capitalizing on momentum. Think about this. On any given day, more than 80% of trades on the stock market are made by algorithms, institutions, and hedge funds, people who are not investing in companies, but are simply buying and selling to make short-term profits. The stock market is not an economy, it's a casino, and the real players are the ones who understand the rules of the game, how to move money around quickly, how to influence market sentiment, and how to make money even when the underlying company or economy isn't growing at all. Now, let's break down the hidden forces behind this system. When you buy a stock, you're technically purchasing a tiny sliver of a company. But that sliver isn't tied directly to the company's performance. It's more tied to the expectations around that company. Take the 2008 financial crisis, for example. Major companies like Lehman Brothers or Bear Stearns were falling apart, but their stock prices didn't reflect the reality of their financial health until it was too late. Investors were focused on speculation, on what could happen, rather than what was happening. They were betting on an illusion. In fact, there's a whole ecosystem of financial instruments that are not tied to the actual value of companies. Things like derivatives, credit default swaps, and options. These aren't stocks, they're contracts based on stocks, on interest rates, or on entire markets. They're built to bet on price movements, and often they don't have anything to do with the company behind the stock at all. And here's the kicker. When companies issue new shares, they're not always doing it to raise capital for growth. Sometimes they're doing it to pay off debts, to balance their books, or to satisfy investors who want more shares. This doesn't necessarily mean the company is getting healthier or more profitable. It just means the stock price is doing what it's designed to do: move. Take a look at the GameStop saga in early 2021. You might remember how retail traders, the so-called meme stock army, sent GameStop stock soaring against all logic. The company wasn't profitable. It was on the verge of becoming obsolete, yet its stock price skyrocketed. Why? Because the stock market had nothing to do with the company's value. It was all about perception, about momentum, and about people betting that other people would keep buying. This highlights the irony of the system. The stock market's performance, whether it's up or down, has very little to do with the real economy. In fact, you could have a booming economy, and yet the stock market could crash if the speculation is negative, or vice versa. And here's where it gets even more absurd. If you look at the last decade, we've seen periods of unprecedented stock market growth, often fueled by cheap money, government bailouts, and monetary policies designed to keep the market going. But that growth hasn't always translated into wage increases, job growth, or economic prosperity for most people. In fact, it's often left many behind. The stock market has become an engine of wealth creation for the few and a bizarre game for the rest of us to try and play. So, what's the bigger picture here? The stock market's true function has been distorted over time. It's no longer about companies getting funding for innovation. It's about a global game of financial chess where the value of companies, economies, and even currencies are decided by factors far removed from reality. Here's the risk. As the stock market becomes more decoupled from actual company performance, it becomes more fragile. A few big players can crash it. Algorithmic trading can cause massive sell-offs based on tiny shifts in market sentiment, and everyday investors are left holding the bag without really understanding the system they're a part of. We're now living through a time where stock market crashes don't necessarily mean the economy is in free fall, and the rise of bubble stocks doesn't signal real progress. In fact, these movements can sometimes be the exact opposite of what's good for the economy. So as you watch the stock market tick up or down, remember, it's not really about stocks. It's about something deeper, something more complex, and something far less stable. The question is, how long can this illusion last? At what point do we stop calling it an economic indicator and start seeing it for what it really is, a giant game of financial manipulation? It might be time to ask ourselves who's really winning in this game, and whether it's a game we should be playing at all.